Buying property with an SMSF seems to be all the buzz right now, especially in Australia. Now your super fund will be able to borrow funds to do so. More and more Aussies are considering using a self-managed super fund as a purchasing structure, and we can understand why. There's a lot of reassurance in seeing your superannuation fund actively working and growing your retirement because you're in the driver's seat. But here's the twist. While borrowing to fund a property through an SMSF sounds promising, it's not a simple game of Monopoly. There are rules, risks, and rewards. And before you jump in, let's ensure that you are well equipped for this property adventure. Let's start with the basics. What exactly is an SMSF? SMSF stands for Self-Managed Superannuation Fund. It's a type of superannuation fund that allows you to have more control over your retirement savings. Unlike an industry superannuation fund where you are limited by the number of investment options, a self-managed superannuation fund allows you to make your own investment choices and have more control over your retirement savings. Now, there are some rules and regulations that you need to be aware of when it comes to buying property under an SMSF. Let's start with purchasing a commercial property in a self-managed super fund. The first thing that you need to know is that the property must meet the sole purpose test. This means that the property must be solely used for business purposes only, and it cannot be for personal use or to benefit members in the SMSF. Another important rule to consider is the arm's length rule. This means that if you plan to purchase a property through your SMSF, it must be done at market value. You can't buy it from a related party at a discounted price, as this would breach the arm's length rule. So let's say you're a business owner and you're selling an office space to yourself below the market value. As tempting as this might sound, you can't do this because selling your property through a discounted rate would violate the arm's length rules. All the transactions must be conducted as if they were between strangers. Even if it's between yourself and your own self-managed super fund, you have to sell it at market rate to ensure fairness and consistency. If you decided to sell your own business premise to your self-managed super fund, you can then rent the business premises from your SMSF to your own business. This means that the commercial rent that you pay from the business to your self-managed super fund is tax deductible in your business and it will be treated as income in your self-managed super fund. Please note that the rent that you pay to your own self-managed super fund must also reflect the market value of rent for similar properties. Now, let's talk about residential properties because the rules here are a little bit different. You can purchase a residential property under an SMSF, but there are restrictions on who can live in it. In general, the property can't be rented or used by a member of the SMSF or any related party. This includes your immediate family members like your spouse or children. The property must be purely an investment and not a personal residence. And if you're thinking of using your SMSF to buy a beautiful beachfront property that you've always dreamed of retiring in, think again. While the idea might sound tempting, if you purchase this property through your SMSF, you can't use it for your weekend getaways or family holidays. It must strictly serve an investment purpose, like being rented out to unrelated party. So, we've broken down all the rules. Let's talk about the benefits of buying property under an SMSF. One of the main benefits is the potential for tax advantages. With an SMSF, you can claim tax deductions for the expenses related to the property, such as interest on loans, property management fees, and the maintenance costs. This can help reduce your taxable income and increase your overall returns. Another benefit is the potential for capital growth. Over time, property values generally tend to increase. And by adding property to your SMSF investment strategy, you have benefit from this capital appreciation. This can help you grow your retirement savings and provide you with a more comfortable lifestyle in the future. And probably the main reason why people invest in their super funds is the tax benefits. You're only required to pay 15% tax on rental income from the property, which is likely less than your marginal tax rate. If you sold your investment property when you are in account-based pension phase and you've met the conditions of release, then you would be able to pay zero capital gains tax on that property. And I don't know whether you know the implications of this, but it's massive. Like, we could be talking about hundreds of thousands of tax savings as opposed to investing in a property outside of your super fund. definitely speak to an accountant like myself to calculate the potential tax savings that you may have in a self-managed super fund. But you also have to think about the considerations and risk. Firstly, there are costs involved in setting up and maintaining the self-managed super fund. You need to pay for professional advice, accounting fees, annual audit, software fees, which can all eat into your overall returns. And while you have a lot more freedom, you have a lot more work. Being able to purchase property in your SMSF with the borrowings come with very strict rules and obligations that you might not be familiar with, as they are not a requirement outside of an SMSF. And unfortunately, we see trustees that unknowingly breach these rules because they are not familiar with the rules until they get audited. I've heard in the past that someone has been fined about $20,000 because they breached the SMSF rules. So definitely be careful with what you do with your SMSF. It's also worth mentioning that all the trustees are personally liable for any decisions made by the fund, even if they have third parties helping them. So you need to really consider this responsibility, which leads me to the next question. Should you buy a property with an SMSF? Well, it ultimately depends on your individual circumstances, your goals, and your risk appetite. If you're looking for more control and flexibility over your retirement savings and you're willing to take on the extra work and responsibilities and risk associated with property investment, then perhaps an SMSF is a good option for you. But it's crucial to seek professional advice from a qualified financial advisor or an SMSF accounting specialist before making any decisions. They can help you assess your personal situation, understand the rules and regulations, and determine if buying a property under your SMSF aligns with your overall investment strategy. Remember, buying a property under your SMSF is a long-term commitment. We're talking about all the way until you retire. It's important to have a comprehensive plan in place to ensure that you're maximizing your return and minimizing your risk. So do your research, seek professional advice, and make an informed decision. And that's it from me. See you next time.